Welcome to the Emperor's webinar series. The presentation today is the closed plan for uniformed patrol employees of the Missouri State Highway Patrol. My name is Mary Jordan and I am a Senior Benefits Specialist here at Emperor's, and I will be your moderator today. Here is some important information we want you to know about today's presentation. The content of this presentation is targeted specifically for closed plan uniformed patrol members. Additional webinar installments targeting the other plans administered by Emperor's can be found on our Education on Demand section of our website, empers.org. Before we get started, I want to take care of a few housekeeping items. I want to let you know that your microphones have been muted, and this is for the benefit of all attendees. However, you still have the opportunity to participate. You can type questions at any time during the webinar. Due to time constraints, we will address a sampling of those questions at the end of the webinar if you want to stay on the line. If not, a recording of the webinar, including the question and answer section, will be made available at a later date. But remember to ask those questions when you think of them throughout the webinar. If we don't have time to get to your question during the webinar, we will contact you directly by email after the presentation. I would also like to mention the attachments. There are attachments available in the handout section. These include the plan handbooks, a comparison of retirement plans brochure, and a copy of the presentation slides. You can download them from here at any time during the webinar, or they can be found later on our website. The last item I want to mention is that a short survey will be provided at the end of the presentation today and also in a follow-up email, but you only need to complete it once. But we do encourage you to give us your comments. This will allow us to make adjustments to our presentation so that we can enhance your experience at future presentations. Now, before I hand off the presentation, let me introduce your presenter, Jamie Mullen. Jamie is also a Senior Benefits Specialist here at Emperor's, and he specializes in retirement and disability counseling. Jamie, I'll let you take it from here.
Well, thank you very much, Mary, and thank you everyone for attending. As Mary said, my name is Jamie Mullen. I'm a Senior Benefits Specialist here. And this is the 6th installment of our webinar series, and our goal with all of these webinars is for you to know and understand your retirement benefits. We are going to discuss a lot this morning in a condensed period of time. A lot of you might be familiar with our pre-retirement seminars. When you get close to retirement, we're going to discuss all of these issues in great detail. We're going to go over essentially the same content, but again, in a shorter amount of time. So here's what we're going to discuss. We're going to frame this overall discussion in terms of what type of retirement plan this is, that being a defined benefit plan. Then we're going to get into the specifics of your particular defined benefit plan, which is the closed plan. We'll talk about retirement eligibility, at what age you become eligible to retire. Of course, we'll talk about how much the benefit will be, that being the benefit formula. Eventually, when you do retire, the COLA, or cost of living allowance, will become very important to you. This is a raise that you'll receive every year for the rest of your life on your retirement benefit. We'll also talk about a common option called the backdrop. We'll explain how that works. That's essentially a way to get a lump sum of money right away in addition to a lifetime retirement benefit. There's also different payment options that you can choose so that you could potentially leave your benefit to a loved one upon your death. Hopefully, with all of this, we can impress upon you the overall value of this benefit. And then, of course, there's a lot of other considerations when we're talking about retirement, so we'll point you to those as well. I would like to mention that I'm going to be using the term retirement benefit and pension benefit interchangeably, so they'll be meaning the same thing. All right, so starting off with the defined benefit plan. The way the defined benefit plan works is quite simple. There's no active decisions that you're making. You just simply work. You show up to your job with the patrol. Once you've worked a certain number of years, you become vested in the plan. So vesting means that we owe you a future retirement benefit no matter what. So you become vested. That's currently 5 years of service in our closed plan. Eventually, you retire, and then once you do retire, we pay you once per month for the rest of your life no matter how long you live. Now, how much do we pay you? Well, that's the defined part of this. This is a formula that's set in Missouri law that takes into account your service, your salary, and a multiplier. So the combination of the product of those three factors equals your lifetime monthly benefit. So as a general theme here, the longer you work and the higher your pay, the higher your lifetime benefit will be. Now, kind of behind the scenes is how we fund these benefits. One thing that's very important for you to know is that you're not putting any of your own money into this plan. This is funded entirely by your employer on your behalf. So Empress collects these employer contributions, and then we invest them with a long-term perspective on our investment strategy, so that we can pay not only current retirees that are receiving benefits, but also eventually you when you do retire. Advantages of a defined benefit plan. Well, number one, it's your employer that bears the risk of investing. In other words, we're going to pay you that benefit based on that formula no matter what the conditions in the marketplace suggest at the time that you retire. So you can be secure in knowing that your benefit is always going to be based on the amount of service that you have and your average salary, regardless of what's going on in the marketplace. Then, of course, you cannot outlive your benefit. We'll pay you once per month for the rest of your life, no matter how long you live. Just a little side point that I'd like to make is that we administer 3 defined benefit plans here at Empress. There's the closed plan, the year 2000 plan, and the 2011 tier. Of course, the purpose of this particular webinar is to talk about the closed plan. Now, as a backdrop to this entire discussion, I'd like to have for you to keep in mind the kind of an overall retirement readiness. So, if you have a lot of years with the state of Missouri, this Empress defined benefit plan is going to be a solid pillar to your overall retirement security. Now, we as state employees, we also contribute to the Social Security system, as does our employer on our behalf. So if we have an average working career, that's going to be another solid pillar to our overall retirement security. And then any shortfall that's realized there, you need to make up on your own with personal savings. So we'll talk about the Missouri Deferred Compensation Plan, which is a nice tax advantage savings vehicle that we have as state employees to kind of supplement our overall retirement readiness. All right, so let's get into the details of the plan itself. Again, we're talking about the closed plan. This is for members that were hired before July 1 of 2000, and then they remain employed until becoming vested. And again, that vesting requirement in the closed plan is 5 years of service. Now, this is important. Closed plan members can choose to retire under the closed plan or the year 2000 plan. Now, this particular group is Uniform Patrol Closed Plan, and there's some inherent advantages for Uniform Patrol members in the closed plan. But since you are technically eligible to choose between the closed plan and the year 2000 plan, I'm going to be showing you provisions of both plans so that you have your entire picture. But again, we'll highlight those advantages of the closed plan for Uniform Patrol members. All right, so normal retirement eligibility. This is simply the point in time where you could walk out the door, so to speak, and we'll begin paying you once per month for the rest of your life. Under the closed plan, you become eligible to receive this benefit once you're age 55 and you have at least 5 years of service, or under what's called the Rule of 80. This is the point in time where your age plus your service equals 80. So it's very possible that you could hit the Rule of 80 before age 55. So for example, if you're age 50 with at least 30 years of service, you would qualify for normal retirement. You would not have to wait until age 55. Now, there is mandatory retirement at age 60. There's no opportunity to continue working for the patrol beyond age 60. The year 2000 plan, the requirements to retire, normal retirement rather, would be the Rule of 80, and they would also have mandatory retirement at age 60. A little side note here, if you're a vested former employee and you retire under the year 2000 plan, you'd have to wait until age 62 to collect a pension benefit. A vested former employee is simply someone who has stopped working. They're not yet eligible to retire. So they're vested, they're eligible for a future benefit, but they would have to wait until age 62 under the year 2000 plan. That's not the case under the closed plan. A vested former employee could collect it at age 55. Early retirement. There's no early retirement provision in the closed plan. Again, you qualify for normal at age 55 or under the Rule of 80. The year 2000 plan does have an early retirement provision. That would be age 57. and there would be a reduction applied to your benefit for the rest of your life if you took early retirement under the year 2000 plan. All right, so now how is this benefit calculated? This is that benefit formula we talked about at the beginning. Credited service. We take all the time that you've worked for the state of Missouri. We take any unused sick leave that you might have, and then we take any time that you've purchased or transferred. So I'll talk about how you can get credit for the sick leave and how you might be able to get credit for transferring or purchasing time a bit later. But essentially, we take all of that service credit, we multiply that by your final average pay. So what we do is we look at every single paycheck you've ever received, we isolate the 36 months in a row that were the highest, and then we average that amount. So for a lot of people, that's their last 3 years of employment, but that's not always the case. Maybe you worked a lot of overtime at some point earlier in your career. If that's the case, we'll go back to when you were earning more and capture that average salary in order to calculate your lifetime retirement benefit. Then, of course, there's the multiplier. This is simply a number established by the Missouri legislature. In the closed plan, the multiplier is 0.016. In the year 2000 plan, the multiplier is 0.017. Those three factors equal your base benefit. Now, here is one of those major advantages for a uniformed patrol officer to retire under the closed plan. Once we've established your base benefit, we multiply that base benefit by an extra third, and that's the total benefit that you receive for the rest of your life if you retire under the closed plan as a uniformed patrol officer. I will mention that the year 2000 plan, they don't have the extra third, but they do have what's called a temporary benefit. This is a second benefit that you would receive only until the age of 62. This is where we would take your total service, your average salary, and then the temporary benefit multiplier is 0.008. So those three factors would equal your temporary benefit that you would get in addition to your base benefit only in the year 2000 plan and only until age 62. So here is an example to kind of bring those numbers to life for you. We have some assumptions here on the right-hand side. Let's say this person is age 55. They've worked 25 years, and now they've, of course, qualified for normal retirement. Let's also assume that when it's all said and done, their average salary ended up being $4,000 per month. So obviously, your particular final average salary, your total years of service is going to be different. This is just one example. So we've taken the 25 years of service, times that $4,000 average monthly salary, times that closed plan multiplier of 0.016 to equal that base benefit of $1,600. We've then taken the base benefit and multiplied it by an extra third. So this person retiring under the closed plan would receive $2,133 a month. So again, they were receiving an average of $4,000 a month while working. Now their benefit would suggest they would get $2,133 as a retiree. All right, very quickly, this is how that same benefit would be calculated if they chose the year 2000 plan. We would take their 25 years of service times that same final average pay, times the slightly different multiplier of 0.017% to equal a base benefit of $1,700. Then there's that temporary benefit where you have your years of service times your average salary times the temporary benefit multiplier of 0.008 to equal a temporary benefit of $800 a month. So a total benefit of $2,500 a month. Now remember that the $2,500 a month would be paid only until age 62 in the year 2000 plan, and then it would drop to the base benefit of $1,700, whereas that closed plan benefit would pay that extra third for life, so it would be $2,133 under the closed plan for life. Cost of living allowances. So this is another potentially major difference between the two retirement plans. So a COLA, cost of living allowance, simply put, this is a raise that you receive every year for the rest of your life once you've started collecting that retirement benefit. Now, the way the COLA is calculated is that it's between 0 and 5%, and it's based on 80% of the change in the consumer price index. So really, this is a measure of inflation in the national economy. This number fluctuates each year between 0 and 5% based on 80% of the rate of inflation. Now, this is why the closed plan may have a very nice advantage because if you retire under the closed plan, and additionally, if you were hired before August 28th of 1997, then there's a guaranteed minimum 4% COLA until all of the COLAs that you've received equals 65% of your initial benefit. Now, the math happens to work out that this lasts for about 12 years. So you'd receive this guaranteed minimum 4% COLA for approximately 12 years until you reach the cap. Then once you've reached that cap, you would continue receiving the same exact COLA as the year 2000 plan and the closed plan for folks that were hired after that August 28th of 1997 date. Another slight difference is that in the closed plan, the COLA is paid in October, whereas in the year 2000 plan, the COLA is paid either on the anniversary of your retirement date or the anniversary of your backdrop date if you've chosen backdrop. Speaking of backdrop, so this is a payment option. Eventually, when you retire, if you're eligible for backdrop, you can accept a lump sum of money right away, in addition to a lifetime retirement benefit. So how does the backdrop work? Well, you become eligible to retire. The first requirement is that you work at least 2 years past that normal retirement date. Eventually, when you decide to retire, you then choose an earlier backdrop date for us to calculate your benefit on. So what happens during this backdrop period? Well, you're going to receive a lump sum equal to 90% of all the retirement benefits that you would have received had you actually retired on that earlier backdrop date. Now, the trade-off becomes your ongoing monthly retirement benefit is based on your service and salary as of your backdrop date, not as of your actual retirement date. So let's again try and put this example to life with some actual figures. The assumptions are essentially the same, except the only difference now is that this person has worked 2 years past their normal retirement date. So now they're age 57 and they have 27 years of service. Again, they qualified for normal retirement 2 years ago at age 55 with 25 years of service. All right, so let's make an assumption here. Let's say that they received a pay increase in their last 2 years of employment, and that bumped up their final average pay to, let's say, $4,500 a month. Again, their average pay as of their backdrop date was $4,000 per month. Now, let's also assume that this person was hired before August 28th of 1997. So, if we're calculating their benefit with no backdrop, we've simply added the 2 extra years of service, so it's now 27 years of service, times that higher final average pay of $4,500 a month, times the plan multiplier equals a base benefit of 1944. We've taken the 1944 and added an extra third to it. So because of that, the extra 2 years of service and that higher pay, their pension now becomes $25.91 per month. Now, they don't have to accept that payment. They could choose the backdrop. So let's figure out how the benefit is calculated if they choose backdrop. So we go back to their backdrop date and use their service and salary as of their backdrop date. So they had 25 years of service times that $4,000 average pay times that plan multiplier equals the base benefit. The base benefit multiplied by the extra third equals $21.33. Now remember, we're pretending that this person retired 2 years earlier. So what happens during that backdrop period? Well, they start to receive their cost of living allowances. So after 12 months of the backdrop period, they would receive their first 4% raise. So that $21.33 now becomes $22.18. Now, during that second 12 months of the backdrop period, they'll receive another cost of living allowance. So that $22.18 multiplied by 4% then becomes $23.07. So their pension with no backdrop, again, is $25.91. With backdrop, it's $23.07. Now, how do we calculate that lump sum of money? Well, what we've done is we've taken 90% of all the benefits that they would have earned had they actually retired on their backdrop date. So we take that $21.33, multiply it by the first 12 months of their backdrop period to get $25,599. Then we get that second benefit with the first 4% cost of living allowance, $22.18 times 12 months to get $26,623. We add that amount of money The $25,000 plus the $26,000 would equal $52,223. Then remember, it's 90% of all they would have received had they retired on that backdrop date. So we take 90% of that $52,223 to equal a lump sum of $47,001. So again, just to summarize that person's decision in that particular scenario, no backdrop would pay them $25.91 a month, no lump sum to go with it. 2-year backdrop would pay them $23.07 per month and a $47,000 lump sum to go with it. All right, so let's say that you've decided that you're going to take that lump sum. What you do with that lump sum becomes a very important decision. You have a couple of options of what to do there. You can roll that money over to an eligible retirement plan. When you do a rollover to an eligible retirement plan, you delay your tax obligation on that money. So we send the entire amount over to your new retirement plan. Eventually, when you start to pull money out of the retirement plan that you rolled it over to, that's when you start to pay taxes on what you take out of that plan. In terms of what qualifies as an eligible retirement plan, well, the Missouri Deferred Compensation Plan would qualify, an IRA that you have set up would qualify, and then maybe even a 401k with the previous employer or a 403b or something like that. The next option that you have is to take that lump sum as a cash distribution. And so that's very important consideration. If you're considering do that, you'd want to know a few things. The first is you'd have a choice if you'd want to take that all in one lump sum or have that spread out in 3 annual installments. Anytime you take backdrop in cash, that money is taxed in the year in which you receive it. Empress is required to withhold 20% for federal tax. Now, we do not withhold anything for state tax, but you may very well owe state tax when you take backdrop in cash. So you'd want to have it in mind to set some aside on your own to satisfy a potential state tax obligation. There's also the potential for an early distribution penalty. Now, the way the IRS treats normal retirement plans would to penalize you 10% if you're under the age of 59 and a half and taking a cash distribution. However, we have a major exception to that rule, us being a governmental defined benefit plan. As a public safety officer, so long as you separate employment in the year in which you turn 50 or later, then you are not subject to that 10% early distribution penalty. You'd only be subject to the taxes on a cash distribution. That exception to that rule is age 55 for civilians, but for public safety officers, the exception becomes age 50. So it's very important that you understand these considerations. If you are considering taking backdrop, you'd want to make sure that you contact us to make sure you know your options. Of course, you could also do a combination in cash rollover. So if you knew you needed a certain amount in cash right away and you didn't want to pay taxes necessarily on your entire lump sum, you could have us pay you a certain amount in cash and then roll the rest over and delay your tax obligation. All right, so now transitioning into the payment options. So again, you've decided to retire. You're going to receive that lifetime monthly pension based on that benefit formula. Now you have to choose a payment option. The very first option is available to everyone. It's called the life income annuity. This means that we pay you the highest monthly benefit possible. There's no reduction applied to it. You get it for the rest of your life, no matter how long you live, and then upon your death, it ends. There's no survivor benefits. This next option, called the joint and 50% survivor, this is available only if you're married, and it means that under the closed plan, you actually don't have a reduction to your benefit to provide a 50% survivor option. You'd actually get the same exact benefit as the life income annuity, the unreduced benefit in the closed plan. Now, this means that if you die before your spouse would get half of your benefit for the rest of their life, no matter how long they live. The third choice is also for someone who's married only. It's called the joint and 100% survivor. With this choice under the closed plan, your benefit is reduced, so we'll apply a reduction to your benefit for the rest of your life. But in exchange for that reduced benefit, upon your death, your spouse would get all of your benefit for the rest of their life, no matter how long they live. Now, when you take a reduced benefit with one of these joint and survivor options, if your spouse happens to die before you, then at that point we eliminate the reduction. We call that a pop-up, and at that point we start paying you that higher life income annuity benefit for the rest of your life. The last choice is called guaranteed payment options. This is available to everybody. This is a way to potentially leave a benefit to somebody upon your death, and this could be anybody. It's not restricted to just a spouse. This could be a friend, a child, a loved one, or even a charity. With these guaranteed payments, what happens is you accept a reduced benefit for the rest of your life, and you'll receive a benefit for the rest of your life no matter how long you live. The difference is that the system guarantees a certain number of payments beginning when you retire, so that if you died before the system paid all of the guaranteed payments, then any remaining payments from your death until that last guaranteed payment would be payable to the beneficiary that you've chosen. The danger there, of course, is that you outlive those guaranteed payments and the beneficiary would receive nothing, and then you would have been saddled with that reduced benefit for the rest of your life. So that option does have some utility in some certain unique circumstances, but it is a pretty uncommon option. Now, these reduction factors that I mentioned, these are detailed in the plan handbooks if you're curious. However, anytime we send you an estimate of your retirement, or if you run your own estimate for retirement, those reduction factors will be automatically figured into those estimates, so you don't have to do the math on your own. All right, so shifting gears now to try and show you the overall value of this benefit. Now, the first thing to consider is, and I mentioned this at the beginning, you are not contributing any of your own money to fund this future benefit. This is a contribution that's made entirely by your employer. So if we're looking at these same assumptions here that we've been going with all along, let's say this person hit age 55. They're not going to stay for the backdrop. They've decided to retire after 25 years of service. They had that $4,000 final average salary. For this particular example, let's assume that they were hired after August 28th of 1997. So they'll still receive a COLA for the rest of their life, but there won't be a guaranteed minimum COLA. But the average COLA, just kind of a historical perspective, has averaged somewhere close to 2%. Obviously, we don't know what future COLAs will be, but that's the assumption I'm using here. So after their first year of retirement, they would have collected over $25,000 in pension benefits. After 10 years, that moves up to over $280,000. And look here, after 30 years of retirement, they would have collected over $1 million in pension benefits. So again, that to me is a valuable benefit. And then, of course, you have to take this into consideration with also your Social Security and your personal savings. So this would be the closed plan example. This is the year 2000 plan example using the same assumptions. The difference here, of course, is because they're receiving that temporary benefit until age 62, they're going to receive a slightly higher payout in the very early years of retirement. And then over the course of 30 years, this year 2000 plan retiree, under these same assumptions, could have expected to receive close to $900,000 in pension benefits. So as you're looking at these numbers and figures, we caution you not to base your particular decisions on the figures depicted in this presentation. There's a lot of factors to consider when you're going over different plans and payment options, such as the time value of money, your age and life expectancy, other sources of retirement income and savings that you might have. You might be considering working somewhere else after retirement. So if you're struggling at all with these decisions, we recommend that you contact a qualified financial professional to help you with these decisions. All right, moving along here, I'd like to point you towards some other resources where you could learn about these benefits. The secure member access portion of our website. So our website is empers.org, and once you're at our home page in the upper right hand corner, there's a green bar that says My Empers Login. So once you've logged into our website, One of the best things that you can do as an active employee, there will be a menu choice called Estimate a Benefit. And once you've navigated to this screen, you can have the system run estimates for you. So the system will take into account your current pay and your current service, and it will project those figures forward until you're eligible to retire. So that's option one. You can have the system simply run you an estimate of your first eligible retirement date, and it'll go through that benefit formula and show you exactly what your benefit would be. Or you can pick and choose date-specific retirement. If you're considering working longer and you want to see how that affects your retirement benefit, you can pick and choose different retirement dates to run. Or perhaps you're not yet eligible to retire, you're considering maybe leaving state employment, you can enter in a hypothetical date of separation, and it'll show you how that would affect your eligibility to retire and the amount that you receive in retirement. So again, these estimates project your current salary going forward, so as your pay increases, that would be a good time to rerun these numbers. There's also another tool within Secure Member Access that might be very helpful to you. It's called the Comparator. You can find the Comparator under the online forms section after you've logged into Secure Member Access. Now, what the Comparator can do is it can show you the difference of your benefit between the closed plan and the year 2000 plan, or if you're set on the closed plan, but you're maybe not necessarily set on whether or not you want to take backdrop. After you've run estimates for yourself and you have your numbers with and without backdrop, you can enter these numbers into the Comparator, and it'll show you your payment stream over the course of your life, taking into account cost of living allowances, so that it can help you decide whether or not taking backdrop would be worth it to you, how much backdrop to take, and so forth. So I would encourage you to give that Comparator a try. All right, some other considerations. So at the very beginning, I established for you that theme of the longer you work, the higher your lifetime benefit will be. So of course, this is your benefit eligible service covered under EMPERS. Simply continuing to work for the patrol will increase your lifetime benefit. Then there's that sick leave component to it. The way that works is you'll get 1 month of retirement credit for every 168 hours of unused sick leave. Now, the sick leave won't allow you to retire any earlier. It won't count towards your eligibility. But eventually, when you do retire, we'll add that sick leave credit into the benefit formula so that you'll receive a higher lifetime monthly benefit. Other state service. Now, EMPERS is unique in that we cover only MoDOT and Highway Patrol state employees. All of the other state agencies are covered under the Moser system. So if you have benefit eligible state service with one of those other state agencies, you could transfer that service from the Moser system to the EMPERS system for free so that it could enhance your lifetime benefit through EMPERS. There's also other public service, potentially. If you worked in a non-federal public position in the state of Missouri, so we're talking like city or county government, perhaps the public school system, the University of Missouri, something like that, there are options to either purchase that time for credit into EMPERS or potentially even transfer that time for credit into EMPERS. There's also police service for uniform patrol employees. If you worked as a police officer anywhere in the United States prior to coming on with the patrol, you could potentially purchase that prior police service for credit into EMPERS. There's also active duty military service. If you have prior active duty military service or even inactive duty military training, there's the potential that you could buy that time for credit into EMPERS. Lastly, there's what's called non-benefit eligible state service. Excuse me. So, non-benefit eligible state service. Oftentimes we may start off our careers in a temporary position or a seasonal position. Maybe we did an internship or something like that where you didn't get retirement credit for that. Well, under the closed plan, there are ways to actually get credit for that type of service. So with all of these different options here listed on the screen, if you have something like that, Again, the rules and laws associated with these different types of service are very unique. So the main point of this is for you to contact us so that we can inform you exactly of what your options are for getting credit for this type of service. Okay, this is another important provision. It's called reemployment. So of course, a lot of people, when they retire and they start collecting an Emperor's pension, they have it in mind to go work somewhere else and collect their Emperor's pension at the same time. So as a closed plan retiree, the only restriction that you have is working full-time in an Emperor's covered position. So what that really means is you can't work full-time for MoDOT or the Highway Patrol. You can, however, work in a benefit-eligible position covered by Mosers and collect your Emperor's pension at the same time. Again, this is under the closed plan only. Under the year 2000 plan, there are tighter restrictions on that. You cannot work in either an Emperor's or Mosers covered benefit-eligible covered position without it freezing your Emperor's pension. But again, back to the focus on the closed plan. You could collect your Emperor's pension and then work for another state agency covered under Mosers. Everyone, closed plan or year 2000 plan, can of course work anywhere else without any restriction whatsoever on your Emperor's pension. So this would include non-benefit eligible state employment. A lot of times people refer to these as 1,000-hour jobs or 1,040-hour jobs. You can do that and collect your Emperor's pension at the same time. But then, of course, you could work anywhere else. Private sector, city or county government, federal government, University of Missouri, just to name a few. Another provision, and this is available to uniform patrol officers that retire under the closed plan. If you were hired before January 1 of 1995, you potentially qualify to receive an extra $90 per month in retirement. We call this the special benefit. You would even receive annual cost of living allowances on this special benefit. This $90 per month is payable until the age of 65. The restriction, though, is that it's reduced monthly by any amount that you've earned during gainful employment. So for practical purposes, if you're going to collect your Emperor's pension and then continue working somewhere else, you're not going to receive the $90 per month special benefit. But once you've stopped working that other job, if you were to contact us, then at that point we start paying you the $90 special benefit until the age of 65. And essentially you can turn this on and off. If you're working kind of sporadically, you could let us know that you're not working so that we do pay you the special benefit. And then once you've accepted employment again, we will withhold that or stop paying you that $90 special benefit. Again, you must have been hired before January 1 of 95 to qualify for that, and that's the closed plan only. So we have mentioned a lot of differences between the closed plan and the year 2000 plan. All those differences are summarized in the comparison of plans brochure. That's again attached in the webinar. It's also on our website. But those major differences being the benefit multiplier. Again, the closed plan receives that extra third. The cost of living allowance structure potentially is different between the two plans. You have different benefit payment options and survivor reduction factors. The reemployment rules are slightly different, and then there's also that $90 special benefit. All right, so some other considerations. Going back to the very beginning of the presentation when I tried to impress upon you your overall retirement picture. So this Emperor's pension is going to be a solid pillar to your overall retirement security if you have a lot of years of state service. You now have a notion as to how much your Emperor's pension will be based on how much service you have and your average salary. And of course, now you can run estimates for yourself to see your actual numbers. So now, to supplement your standard of living in retirement, there's the Missouri Deferred Compensation Plan. We as state employees have the opportunity to contribute to this plan so that we can supplement our retirement income. I would highly encourage you to make sure that you have a savings plan in place, and then I would encourage you to check back periodically to make sure that you're meeting your savings goal. The Deferred Comp's website is listed there, so you can contact them. The other major piece to your overall retirement readiness would be your Social Security benefit. You can visit ssa.gov. Once you've logged into their website, you can obtain estimates of your future Social Security benefit as well. So everyone can take early Social Security at age 62. Normal Social Security, for most of us, it's age 67, but it could be earlier depending on the year in which you were born. So now that you have your Emperor's pension, your Social Security estimates, and an idea of your deferred compensation savings or outside savings vehicles too, you can start to piece together your overall retirement picture. Medical and life insurance is also very important. I would encourage you to contact your troop or the general headquarters to talk about your options for retaining medical and life insurance, as well as the cost for retaining those insurances. And then taxes would be another major piece to this retirement benefit. One very important thing to know is that once you start collecting a pension benefit from Emperors, you're not going to pay payroll taxes on that benefit. So Social Security tax and Medicare tax, you will not pay that on your pension benefit, but you will owe federal income tax, and you potentially will owe state income tax as well. There is what's called a public pension exemption in Missouri. So this means that you may qualify for a partial or full exemption from state taxes on your pension. We are not tax advisors here at Emperors, but I would encourage you to contact the Missouri Department of Revenue, their website's listed there, or a tax professional in Missouri to see how that public pension exemption might impact how much state tax you pay on your pension. Additional resources. You might be familiar with our pre-retirement seminars. This is where we go across the state. We invite folks that are within 5 years of normal retirement eligibility to attend these seminars. We talk about your retirement choices in great detail, your insurance choices, and your deferred compensation. That's about a 4-hour seminar. If you're outside of that 5-year window in terms of becoming eligible to retirement, you still could attend one of these seminars. Within about a week or two of the seminar date, we will open up registration to everyone. So as long as there's still seats remaining, you could register for one of those seminars at that time. Our website is the best source of information, empers.org. And if you have a quick question for a benefit specialist that you've been dying to have answered, you can email us. Our address is empers@empers.org, and we'll get back to you in very short order. All right, I'm going to pull my colleague Mary back here into the presentation. And if there's any questions from the audience that we can answer, I'll do that at this time.
Okay, Jamie, we do have a few questions. We have somebody that wants to know what happens to their vacation time when they retire. Can they use that for retirement service credit also?
Right. So the vacation time is actually separate from the calculation of your Emperor's pension. The vacation time, though, or annual leave, is paid to you by your employer. So if you do have annual leave left over, your employer will pay you for that annual leave. There's also some options there to perhaps apply a portion of that payment to perhaps prepay medical insurance premiums for the rest of the year in which you retire, but that's between you and your employer. You might even have the option to roll over any potential annual leave payout to the Missouri Deferred Compensation Plan.
Okay. Another question, when I'm ready to retire, how far in advance do they have to notify Emperors?
There are deadlines associated with applying for retirement. You must apply for retirement at the very latest within 1 month of your retirement date. And I really call it a month and a day. So for example, if you're going to retire January 1, the deadline to apply is November 30th, a full month in advance of your normal retirement date. Now, you can apply as early as 4 months in advance, but no later than 1 month in advance.
Okay. Next question. When I'm first eligible to retire, what do I do to sign up for backdrop to show I'm working towards backdrop?
Okay, so if you've hit normal retirement eligibility, you decide you're going to continue working because you want to eventually become eligible for backdrop. There's no formal election that you make at that time. You simply continue working as long as you desire, but no later than age 60, of course, which is mandatory retirement. And then eventually when you do apply for retirement, we're going to give you all of the choices that are available to you. So if you've worked long enough to have backdrop as a choice available to you, you'll be able to choose backdrop at the time that you actually do retire.
Okay, I think that's all the questions that we have to take right now, but if you do think of anything later and you want to email us, feel free to let us know of any questions you have. As I mentioned earlier, you will receive a short survey after the presentation is ended. We do appreciate it if you can take a few minutes to complete that for us and give us your feedback. So this does conclude our presentation today. We appreciate your attention and participation. We thank you for taking a little bit of time out of your day today to learn more about your retirement. And don't forget to check back periodically as we'll be adding additional webinars. Thank you.